Hello and welcome to the channel, Exila Trader, and today we're going to go through some basic chart analysis. Euro to the Australian dollar. I see a lot on YouTube and Google and stuff that like basic chart reading or basic candlestick patterns, all of that type of stuff is a very highly searched thing, and a lot of it can be overwhelming, massively overwhelming. The key factors to the market, be it forex or commodities or indexes or whatever, um, they do one of three things. They either go up, down, or across. It's as simple as that. The market will always do one of them three things. It will always go up, or down, or across. That simple. That being said, uh, how do you interpret what it's going to do, how it's going to do it? So, um, I'll put a link in at the end of the video to another video on YouTube that I've watched a few times just to gain the understanding of candlestick patterns and what they mean and what they do. I'll just take this bit here quickly, just looking at this bit here. So there's so much jargon and so much like different names, like loads of different names and stuff, and for all different types of candles, like engulfing patterns, or the doji, or the pin bar, the inverted hammer, the hangman, like loads of things like that. And it gets to a point where you kind of think, I can't be looking for these constantly because surely it doesn't always mean it, and that is true. Just because you have an engulfing pattern, for instance, here, so you can see this is a big engulfing pattern right now. You've got a quite a large um, bull candle going up, and then when it closes, it shoots up, it comes all the way back down, and then it engulfs the last candle that it was in. Right, that's so it's completely engulfed it. Okay, meaning that the market is going to drop soon, which it does. But then when you follow this along, and you see, oh, okay, it's not really dropping that much. If you was watching this real time, every hour, you think, oh, okay, oh, it's gone back up. You'd be like, oh, okay, maybe it's not dropping as we thought. And then you get a small engulfing pattern here, and then you get a another large engulfing pattern here. So your original signal, this bit, so you originally see this, and you think, yeah, the market is going to start going down. But then what happens is you end up with this here, which you think, okay, maybe the market's going up then, and not down, which can be quite annoying because as a inexperienced trader and someone who's new to trading, you're reading all this knowledge and power and stuff and trying to get the understanding of the markets, but then every time you see these patterns emerge, you're double guessing everything, and you're second guessing everything, because if you see this and think, okay, the market's going to go down, and you put a short position there, right, you're going to put your stop loss. That's where your stop loss will be, at the top of the last candle. Essentially, proper risk management. That's what you'd do, and straight away you'd be in profit. And you think, okay, yeah, here we go. It's going to start going down. But then, what happens is the next candle goes up and it stops you out, and you think, what? Like, surely this pattern here is saying it's going down, and I've been stopped out, and this will happen throughout. And then again, you get this, and then you think, oh, okay, no problem. It looks like it's going to be a buy now. So then you'd put a buy position here, you'd have your stop loss down here, and then you get stopped out. And you think, oh my god, how many times is this going to happen? How does this keep on happening to me? Um, and it makes you question everything about all these engulfing patterns and these dojis and the pin bars, and it makes you just question the whole candlestick pattern. Okay, I'm on the hourly chart. It doesn't really give you that much strength as indication. I understand that. If you go to the 4-hour or the daily, then yes, maybe you'll get a better strength of indication. But a lot of inexperienced traders and new traders, they want to do intraday trading. They want to do scalping. They want to take trades on the day, take the profit on the day. They don't want to put a trade in and hold it for 2 to 3 weeks like a swing trader does. They want to see the profit and see the money. That's why they're getting into trading. And they will read this on an hour chart or 30-minute chart, and they will just constantly be hitting their stop losses because it's so hard to determine the correct entry position because there's so many different patterns always emerging. It's hard. It is hard. Of course it is. The best way to do it is to know, well, not the best way, but the way I do it is, instead of looking for these patterns to emerge, what I do is I look for the zones. Okay, the zones of what you need to be looking for is the zones, right? So here you can see this is a clear uptrend all the way up. I mean, I could even run that across to there, and that gives you a breakout, and you can see, okay, that's breaking out, not a problem. But then with this trend line, this is what I always do on all my other videos as well. With this trend line, you see it go up, and you think, okay, you're following this, and you may be lucky and you got on a buy here, and you're going all the way up, and you're trailing your stop loss all the way up, and you know you're in profit, no problem. And then it breaks trend, and you think, okay, it's time to drop out. When's the best time to enter this break from trend and the potential downtrend that is potentially coming? Is to use a consolidation box. Simple as this. You could literally run it from there and think, okay, so I'm up the trend, I'm all the way up here, it's broke out of the trend line here, come for a retest, and it's come down. You've got this big range of movement, up and down, up and down, up and down, consolidation, and then you box it up, and all you're going to do is you're going to drag this box across to the future, right? That is your consolidation box. Originally it was just up to about here, right? But then all you're going to do is you're going to drag it out, okay, your consolidation box. And the minute this is broke trend, retested the trend line, and then came down, once this drops out from here, that is what you're looking at. That is your indication of drop. So much easier way to read a market and understand the market of which way it's going, just from doing that. A simple trend line, a simple trend box, and then watching for the breakout. You have this big drop, and you could have collected, well, you would have collected 142 pips in 1 hour. Easy as that. Your stop loss would be up here, not a problem, top of the consolidation box. You could even pull that consolidation box down to the top of them candles, right? Stop loss there, and it's not been touched. It retraces and touches, and then it drops out. So yeah, you could have bagged 142 pips in 1 hour, not a problem. Or you could have held out, and simply from drawing a simple trend line, a simple consolidation box, there you go. You can do that here. This is going back, obviously, like we're looking back in April area. You could go here, you have this downtrend, big downtrend. You see it breaks out of the downtrend. So what I'm going to do is I'm going to draw my consolidation box. This big range here, that's hit the trend line. That's my consolidation area, about there, because you can see it. It's retested. Once it's broken, all I'm going to do, drag that to the future. And all you're doing now is you're looking, once it's broken that trend, you're looking for that retest, and you're waiting for this area to be breached. You see how it opens, it closes above the consolidation area, not a problem. You would have entered for a buy roughly around there. It would have dropped you out. Your stop loss, risk management would have been here, or maybe halfway, depending on your lot size and what your risk management is. And it would have most probably stopped you out, no problem. Every win, is equivalent to 5 to 6 losses. You can get past that. But once it drops out of here, you're thinking, okay, it's a sell, but then it comes back in for a retest, and it drops out. Now, if you look here, this bottom wick, it doesn't break below this bottom wick. So you could reevaluate and think maybe, okay, if I put this down, if I had this consolidation box on this range, where it had so much retracement on that 1 hour candle, then I kind of see what's happening. Once it bounces and it creates this uptrend, it comes up, it retraces, it retests, and it bounces up to this uptrend. You could have had a buy there, all the way up, catching 186 pips, not a problem, over the space of 1 day, very nice. Okay, but it's as simple as that, using this consolidation box. And as you can see here, this consolidation box that you've marked up, you would have marked up on the 17th, and you've dragged it to the future. You could carry this all the way out, and what you have here, you have this retest, this touch off to the consolidation, it retests, fails, and it drops out. The minute this drops out here, this is another sell, because you know this is lost. This momentum here, it's lost all its support. This was a big consolidation box, big range movement here, lost its support, and it's dropped out. Now you're in a nice downtrend all the way from here all the way down, and you would have just caught that all the way, and you would have carried on. And again, look at this here, so you would have been following, you would have had a sell point here all the way down, a little bit of retracement, but then what you get in here, you're getting a consolidation zone again. It's another consolidation zone over a good few hours. Originally you would have marked it up around here because you could see the movement, the big movement of the wick, the candles, you see how it's bouncing the range, it's come back up level, and you'd go, right, extend that to the future, just like that. So now we're looking in, you'd be following this, it can't break out, it comes up and touches the trend resistance line, and what does it do? It drops out again. So you're entering another sell position here. So you've got a sell position there, you've got another sell position here, and it's going all the way down. It keeps on going. You could do it again here for another consolidation zone, a smaller consolidation zone here with this small range. You could run that there, and you think, okay, that's a nice consolidation zone. I'll run that across to the future, and it drops out, retests, fails the trend resistance line, and drops out again. So that's 3 sell points identified using just a trend line and a consolidation box. Okay, very, very simple. You'll follow this all the way down, and again you get this big range movement here, big range movement. Okay, very big range movement, and all you're going to do, again, it's very simple. Consolidation box, you'd see where it is, extend it to the future, and that marks you up nicely. It drops out, and you think, okay, I'm in for a 4th sell position here. So you've taken 3 lots of sell positions, 1, 2, 3, all in very good profit now, very good profit over the space of a few hours there, a few hours there, and a day. Yeah, a whole day there, taking all them pips there. Lovely. You enter your 4th position here, get down to a bit of profit, but then it retraces up, and you would emotionally move your stop loss to break even, or even trail stops, you know, just whatever you feel necessary within your own trading plan. But once you stop out and you see it break this trend line that you had drawn out, because this trend line would go forever. You'd run this trend line for as long as you possibly can, because you run it everything into the future. You've got to imagine this would not be here. You've got to run this to the future, because this is giving you your indication. Once it's broken, tested, you're in this consolidation zone still. You see how it breaks out, and then the wick tests this consolidation zone. That is your buy point there, and you're going up. This from previous, from the week before when you marked it, you can see you've extended it all the way up to the future still. You've got a break through that one, so that's another buy position there. It's going up. You've got this consolidation zone here that you're going to extend to the future. It goes through. You've got another buy position there, so that's 3 buy positions now, getting you back up. This is the big consolidation zone that we had marked up, okay, from 2-3 weeks ago. You see how you bring it across to the future now, where we are just through this last week, and you see how it plays a massive key factor. Now going to the beginning of this video, what I said about candlestick patterns, if you look at this here, you have a head and shoulders, perfectly formed. Perfectly formed. There's your head, there's your shoulders. Perfectly formed head and shoulders within your consolidation box that you would have put in. It makes sense. It just makes perfect sense every time. Like, as simple as that. You don't need to read the candlestick patterns as such, but you can just see from all these consolidation zones how much it makes sense. And then the minute it comes back down and it comes through here, that's a sell position. Comes down, that's a sell position, and now you see how it's bounced off of this one. It's now forming a new uptrend. It's bounced off of this resistance, this support, sorry, and it's bounced off and it's going up to this new resistance zone. Okay, and then you're going to see this is a buy point. Okay, it may be just testing, so it might consolidate here. Again, you might have to reevaluate your chart, remark your chart, get rid of this zone, readjust here, make a new zone of consolidation, push it out to the future, and then wait for it to either break up or break through and come back down. And it's as simple as that, guys. That simple. Okay, check the link. I'll put it up in the screen. Make sure you like, subscribe, and tune in for the next video. Have a good day.